Welcome to Group Insurance Daily Pulse, your rapid-fire briefing on the critical shifts impacting our sector. I'm Aria, the Actuary, ready to dissect the solvency implications and regulatory headwinds.
And I'm Dorian, the distribution expert, here to highlight the market opportunities and the innovations driving employer value and employee engagement. We've got a packed 15 minutes, so let's jump straight into the data.
Indeed, we're looking at a dynamic landscape.
Our top story, fresh from PwC, indicates persistent strength in insurance M&A, albeit with a fascinating new vector, AI. The sector recorded approximately $29.6 billion in deal value across 191 disclosed transactions from December 2025 to May 2026. While this is a slight decrease from the prior six-month period, 207 deals at $31.8 billion, the narrative here isn't about volume, it's about strategic intent. AI is now a critical determinant, influencing M&A strategies, valuations, and capital allocation. Carriers and reinsurers are aggressively increasing investments in underwriting, claims, and workflow automation. The Corebridge Financial and Equitable Holdings merger in March 2026, valued at $22 billion, exemplifies the scale. This isn't just about economies of scale anymore. It's about acquiring or developing advanced AI capabilities to enhance operational efficiency and drive competitive advantage.
Strategic alignment often translates to integration risk and unforeseen capital expenditures in my book, Dorian. While the headline figures for M&A activity are significant, the slight dip in deal count and value suggests a more selective environment, precisely where AI due diligence becomes paramount. My immediate concern is the valuation methodology for AI capabilities.
Are we accurately assessing proprietary algorithms, data lakes, and model governance frameworks? Or are we overpaying for perceived future efficiencies that may not materialize? The integration of disparate AI platforms post-merger is notoriously complex, carrying substantial P&L implications through delayed synergies, increased operational overhead, and potential write-downs if the acquired tech doesn't scale or integrate as projected. Furthermore, robust AI in underwriting and claims requires massive, clean, and ethically sourced datasets. The regulatory landscape for AI deployment, particularly concerning bias detection, data privacy, GDPR, CCPA equivalence, and explainability, is still nascent but rapidly evolving. A misstep here could trigger significant DOI or federal scrutiny, not to mention severe reputational damage and potential class action litigation.
We must stress the solvency implications of these large-scale technology bets. Ensuring adequate capital reserves aren't eroded by speculative AI acquisitions that fail to deliver projected ROI within the expected time horizon. The long-term P&L impact hinges on validated model performance and rigorous regulatory compliance, not just aspirational efficiency gains.
Shifting gears to product innovation, MetLife Nepal is making waves with enhanced critical illness offerings. They've launched Critical Illness Plus, a new rider providing a lump sum payout upon diagnosis of 11 major critical illnesses. More significantly for our group benefits focus, they've expanded their group critical illness rider, increasing coverage options for employees and their families to include 14 and 20 illnesses. This is a clear move to enhance financial protection, directly addressing employee concerns about rising healthcare costs and the financial burden of severe medical events. From a distribution standpoint, this positions MetLife competitively, allowing brokers to present more robust and flexible benefits packages. For employers, it's a powerful tool for talent attraction and retention, offering tangible support during employees' most vulnerable times and demonstrating a commitment to employee well-being.
Comprehensive health protection and lump sum payouts immediately trigger my actuarial alarm bells, Dorian. While the intent to reduce employee stress is laudable, the underlying morbidity risk for 11, 14, or even 20 critical illnesses requires exceptionally precise pricing and robust reserving. We're talking about conditions with varying incidence rates, severity profiles, and diagnostic criteria across different demographics. Is the pricing for Critical Illness Plus adequately factoring in potential anti-selection, especially if the expanded group options are voluntary and employees are more likely to elect coverage if they perceive a higher personal risk?
We need to scrutinize the definitions of these critical illnesses. Ambiguity can lead to higher claims adjudication costs, increased litigation risk, and potential policyholder dissatisfaction, all impacting P&L. Furthermore, what are the reinsurance arrangements for these expanded riders? Accumulation risk across a broader range of illnesses could strain the carrier's balance sheet if not adequately diversified or reinsured, particularly in a single market. From a regulatory perspective, especially in a developing market like Nepal, ensuring transparent disclosure of terms, conditions, and exclusions is paramount to avoid consumer protection issues and maintain market conduct compliance. The P&L impact of mispriced critical illness products can be substantial and long-lasting, especially with increasing medical diagnostic capabilities, potentially leading to earlier, more frequent diagnoses of covered conditions, accelerating claim incidence. We need to ensure that the perceived value for employees doesn't translate into unsustainable risk for the carrier's solvency.
Moving to state-level regulatory impacts, Connecticut Governor Ned Lamont is proposing a significant $100 million Medicaid levy on large employers. This per-employee charge would apply to for-profit companies with at least 100 employees and nonprofits with 1,000 or more employees, specifically targeting those whose employees rely on Medicaid for healthcare. The stated aim is to offset federal cuts and rising healthcare costs under the Affordable Care Act. From an employer standpoint, this is a new direct operating cost that will require immediate P&L consideration, potentially influencing benefit design strategies and contribution levels. However, from a broader perspective, it's an innovative, albeit controversial, approach by a state to address its fiscal challenges while attempting to hold large employers accountable for the social safety net.
Innovative approach is one way to frame it, Dorian. Direct tax on employers that could disincentivize offering comprehensive benefits is another, more accurate assessment from a risk perspective. This $100 million levy directly impacts the P&L of large employers in Connecticut, forcing a reevaluation of their total compensation and benefit strategies. My primary concern here is the potential for adverse selection and a race to the bottom in employer-sponsored coverage. Will employers, particularly those with a significant portion of their workforce on Medicaid, now consider reducing their employer-sponsored health coverage or increasing employee cost sharing to avoid this levy, effectively pushing more employees onto the state system and exacerbating the very problem the levy intends to solve? This also raises significant ERISA preemption questions. Is a state-level levy directly tied to employee healthcare utilization and impermissible encroachment on federally regulated employee benefit plans? We could see legal challenges from employer groups, creating prolonged regulatory uncertainty for carriers and brokers. Furthermore, the administrative burden of accurately tracking which employees utilize Medicaid and calculating the per-employee charge for employers is non-trivial and prone to errors, adding compliance costs.
For carriers, this could lead to shifts in group enrollment patterns, potentially destabilizing risk pools, and requiring adjustments to underwriting assumptions for Connecticut-based employers. The DOI will undoubtedly be scrutinizing how carriers and brokers advise their clients regarding this new financial obligation, ensuring compliance and transparent communication about its implications. The long-term solvency impact on employers in the state, particularly those operating on thin margins, cannot be understated.
Good point on the regulatory landscape, which brings us perfectly to our next update. The DOL has confirmed that civil monetary penalties for employee benefit plan violations will remain unchanged for 2026. This decision, attributed to a government shutdown in late 2025 preventing necessary data collection for inflation adjustments, means the daily penalty for failure to file ERISA Form 5500 stays at $2,739, and for failure to provide a summary of benefits and coverage, SBC, it remains $1,443 per failure. While unchanged might sound like a reprieve, the critical takeaway here is the reinforcement of substantial financial risks associated with noncompliance. It's a stark reminder that these existing penalty amounts are already significant. For employers, this underscores the absolute necessity of robust compliance practices for ERISA and group health plans, including meticulous record-keeping and timely filings.
Stable is a relative term, Dorian. Unchanged due to a government shutdown highlights systemic vulnerabilities in our regulatory infrastructure, which itself poses a risk of unpredictable future adjustments. While the penalties haven't increased, their mere existence at these substantial levels represents an ongoing material P&L risk for employers and plan fiduciaries. The daily penalty for Form 5500 non-filing at $2,739 can quickly accumulate to hundreds of thousands of dollars in a fiscal year, directly impacting a company's bottom line and cash flow.
Similarly, SBC violations at $1,443 per failure can multiply rapidly across a large employee base, leading to significant aggregate fines. My actuarial lens focuses on the contingent liability these penalties represent. Are employers adequately reserving for potential fines, especially those with complex multi-state benefit plans or those undergoing M&A activities where compliance gaps might be inherited? The DOL's consistent enforcement, even without inflation adjustments, means audit risk remains high. Fiduciary liability under ERISA is personal, and these penalties underscore the importance of robust internal controls, documented compliance processes, and regular external audits. Carriers providing administrative services for group plans also bear a significant responsibility to guide clients away from these pitfalls, as their reputation and potential liability could be impacted by client noncompliance.
The cost of compliance, while seemingly an overhead, is a direct mitigant against potentially crippling regulatory fines. The message isn't penalties are stable, it's the cost of noncompliance remains prohibitively high.
Absolutely, compliance is non-negotiable. And speaking of mitigating high costs, our final item brings us to the self-funded market. Crum & Forster's Accident and Health Division has appointed Brett Feldman as VP of CNF Stop-Loss Underwriting. This strategic move comes amidst a challenging environment. Total health benefit costs per employee are projected to rise by 6.5% on average in 2026, building on stop-loss premium increases for 2025 that range between 8.8% and 10%. The most telling data point for me is that claims exceeding $1 million are now reported by 49% of plan sponsors, a staggering increase from just 23% in 2024. This isn't just a trend, it's an undeniable shift in the risk profile for self-insured employers, driven by high-cost claims. Feldman's appointment signals a heightened focus on strengthening stop-loss capabilities, which is crucial for carriers like CNF to maintain market share and profitability.
Absolute necessity is correct, Dorian, but the actuarial implications of these trends are deeply concerning. A 6.5% projected rise in total health benefit costs for 2026, coupled with 8.8 to 10% stop-loss premium increases in 2025, indicates a significant acceleration in medical trend, far outpacing general inflation. The jump from 23% to 49% of plan sponsors reporting claims over $1 million in just 1 year is not merely telling, it's a flashing red light for reserve adequacy and solvency across the stop-loss sector. This suggests either a dramatic increase in the incidence rate of high-cost claimants, an escalation in the cost per high-cost claim, or a combination of both, potentially driven by advancements in specialty pharmaceuticals, gene therapies, or complex surgical procedures. My immediate questions revolve around the underlying drivers and their long-term sustainability. For CNF and other stop-loss carriers, this necessitates a rigorous reevaluation of underwriting models, pricing assumptions, and reserving methodologies. The risk of adverse development on prior year claims, especially with the increased frequency of mega claims, is substantial and directly impacts P&L. This also impacts the entire self-funded ecosystem, TPAs, reinsurers, and ultimately the employers themselves who are trying to manage their financial risk.
Unquestionably, Aria, the data demands sharp strategy and even sharper execution.
Precisely. From AI and M&A to state levies and the escalating costs in stop-loss, the group insurance landscape is undergoing rapid, complex transformations. Understanding these shifts isn't just about market share, it's about financial integrity and sustainable growth.
And delivering consistent value to employers and their employees in an increasingly intricate benefits environment. That wraps up our Group Insurance Daily Pulse.
Thank you for joining us for this dense dive into the latest data.
We'll be back tomorrow with more insights. Stay informed.